Stock portfolios, diversification versus concentration. Do you own too many stocks? Well, it depends. By the end of this video, you're going to have a very high-level understanding of both diversification and concentration. I'll also be showing you my own portfolio and how I implement these concepts into my own investing. With that all out of the way, let's begin. First, let's begin with a definition of diversification and compare that with concentration. Diversification is allocating capital in a way that reduces exposure to any one particular asset or risk. In other words, we could achieve diversification by putting money into different asset classes, such as stocks, aka equities, bonds, real estate, commodities, etc. Because the stock market, generally speaking, provides the greatest returns, for our conversation today, when we talk about concentration diversification, we're going to be talking about the stock market. A concentrated portfolio is simply more focused. It's not that it doesn't have any diversification, it just has fewer overall positions. Because of this, a concentrated portfolio is going to be more volatile, but it does have the potential to provide greater returns. So the million-dollar question becomes, what is the ideal number of stocks to hold in a portfolio? Well, it depends. It depends on a few things. Number one, your tolerance for risk. Number two, your investing time horizon. We need to balance risk and reward. As you can see from this chart, the greatest reduction in risk comes from the first couple stocks added to a portfolio. An equally weighted 3-stock portfolio is substantially less risky than a 1-stock portfolio. We notice a still further reduction of risk when we go to, say, 7 or 10 stocks. At this point, though, additional holdings reduce risk at a decreasing rate. So as far as risk mitigation goes, we see a diminishing benefit as we add each additional stock. I would argue that someone who is holding 25, 30, and certainly 40 plus stocks has too many. How can you keep track of that many companies? Besides, the more and more companies you begin to own, you're going to start achieving returns much more similar to an index. So if you own that many companies, why not just buy an S&P 500 index fund? If you want market returns, just buy the market. Here, we're trying to beat the market though. So if we're trying to beat the market, why would we create a portfolio that largely replicates it? We want to have fewer stock positions. Maybe someone with a smaller portfolio would want to have 5, 7 positions. Someone with a larger portfolio might want a little bit more risk reduction and hold maybe 10 to 15 stocks. But I would argue that anyone who holds 40 plus stocks is wasting their time. Buy the index, save yourself the time, and be done with it. In my opinion, a portfolio with fewer than 3 stocks is pretty crazy. But by the same token, a stock portfolio that has 30 plus positions is equally crazy. In addition to that, if you've got a smaller portfolio, say like $1,200, there's no point to be scattering that among 15 or 20 companies. You know, if that were me and I had $1,200, I'd probably pick 1 to 3 companies and invest in those companies. And then as I started to add capital, I would increase the number of positions that I hold. But again, there's no point in having 20 plus positions if you're working with less than $10,000. It just doesn't make any sense. For me personally, I've been investing for about 6 years, and in that time, I've been able to grow my accounts. At this point, I'd say that I'd be comfortable holding a minimum of about 3 to 4 positions. Ideally, in the near future, I don't want to be exceeding approximately 8 to 10 core holdings. Keep in mind, though, that I do reserve about 10% of my portfolio for riskier, more speculative type investments. So what do you guys think? Am I crazy for suggesting holding these few companies, like single digits? I know it's kind of crazy for most mainstream type investing recommendations. All over the internet, diversify, diversify, diversify. It's just all over. I'd argue that concentration is the way to go for people who are trying to generate outsized returns. And if you don't believe me, don't take my word for it. Let's check out this clip from Warren Buffett. He has something to say about concentration.
We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything.
Warren Buffett goes on later in that clip to say that there's nothing wrong with investing in the S&P 500 or an index like that. In fact, he recommends it for a lot of investors. But he says for people who understand businesses well enough to invest in individual companies, it, quote, makes no sense to invest in number 30 or 35 on your list of attractiveness and forego putting money in number 1 just strikes Charlie and me as madness, unquote. So, what does all this mean, and how does this impact you and your portfolio? Well, that's completely up to you. I'm just here on YouTube for your fun and entertainment only. I am not a financial advisor, and this is not financial advice. My risk is different than your risk. All I can do is tell you what I might do. If I were to start all over, probably I would invest my money into an S&P 500 index fund. At this point, I would start doing research. I would learn how to value companies and read financial statements. I'd find a few companies that catch my interest and slowly start moving some of my money from the indexes into these individual companies. Then, over time, a greater and greater percentage of my portfolio would be in these individual companies until eventually all of my money has moved over. Almost by accident, this is what I did about 5 years ago without even knowing it, and if I were to do it all over again, I'd probably do something very similar. On the other hand, if I were already invested in a bunch of different individual companies, I would slowly, over the course of some weeks and months, sell my lower conviction holdings and reallocate that into my higher conviction stocks. By doing this, I'd be able to increase the concentration of my portfolio and hopefully the return as well. One final note on risk. Just because your portfolio may have the exact same number of companies as someone else doesn't mean each portfolio contains the exact same level of risk. There are more factors that go into this than just the number of positions held. For instance, a portfolio consisting of Apple, AT&T, and Johnson & Johnson will clearly have less risk than a portfolio of 3 speculative companies that are all in the exact same industry. The goal should always be to have the greatest level of diversification and the least amount of risk within a portfolio of the few stocks that we do hold. That should always remain the goal. If you're nervous about owning fewer stock positions, I've got a strategy that I've been developing that will help to decrease downside risk, particularly when entering a new stock position. So stay tuned for that and more. Before we wrap up, let's jump into a quick portfolio review. What's up, guys? This is the first time you are seeing my Robinhood brokerage account. Today is just going to be a quick overview of the account, and in future videos I'll be diving into greater detail on the portfolio. So as you can see, this is a concentrated portfolio, only 5 stock positions here, 3 of which making up the bulk of the portfolio. Tattooed Chef, the biggest position here, is a plant-based frozen food manufacturer. They're vertically integrated, so they produce all of their product in-house. There's a lot of growth potential here. It's already at a very attractive valuation. Really liking the industry here. It's becoming more mainstream. Even people who do not consider themselves vegan or vegetarian are eating these sorts of products, and Tattooed Chef is selling incredibly well. Next company, Corsair Gaming. They're at the forefront of the streaming and gaming industry. They're known for acquiring very strong brands. Elgato is actually the manufacturer of the microphone that I'm speaking into right now. Really well capitalized as well, and close to break even or even slightly profitable now. So any debt that they do have, that risk is kind of mitigated because of their ability to be generating profits in the near future. They're at a 1.5 price to sales ratio, so unbelievably cheap right now if you're buying Corsair Gaming, in my opinion. Strong growth ahead, as I mentioned, so this is a very strong conviction with this one. Next, we've got Dropbox. You're probably familiar with the company, even if you don't use the service. This is a little bit of a slower growth company, but very stable, profitable, sustainable business model. They have low customer concentration, so their earnings reports are usually kind of boring because they just barely beat expectations and then just continue to grow slowly over time. I've been selling a lot of covered calls on Dropbox, both in this account and in my retirement account. That's been going incredibly well for me, so I'm going to continue with that strategy. Next, Micron. I actually just purchased this stock today and plan to grow this particular position over the coming next few months. Would love to put at least $10,000 into this one, maybe more as long as the price stays around its current levels. Next, Smile Direct Club. I acquired this one by selling short puts that got assigned to me. I'm currently selling covered calls on Smile Direct Club, but I am bullish on the company, even though it is a little bit more of a volatile one. So these are the stocks in the portfolio. I have a few options positions. I'm not going to go into that in this particular video, but I do dabble in some options and will be making some options videos going forward. This past week, some kind of interesting things that went on. Monday, Corsair Gaming was in the Wall Street Bets crosshairs, and the price just spiked on Monday. So the portfolio got all the way up to a little over almost $75,000, and then it's just been downhill ever since. But mid-60s, upper 60s, that's a little bit more of a realistic portfolio value at this point. Looking to grow this portfolio to closer to the six-figure mark by the end of the year, hopefully with contributions and growth. So follow along to see how that happens. If you made it this far, please like the video, comment, and subscribe. And until that next one, peace.